What most people are watching right now is silver. The headlines, the price levels, the noise. But while attention is fixed on what feels obvious, something quieter is tightening underneath the system. It isn't dramatic. It isn't trending. And that's exactly why it's dangerous. This is how real stress builds out of sight, until it suddenly isn't. What you're seeing form right now isn't a single market event. It's a structural imbalance, a pressure point that sits upstream from stocks, bonds, and even precious metals. When that pressure shifts, everything downstream has to adjust, not because of panic, but because the math stops working the way it used to. If you value calm, research-driven breakdowns of what actually moves markets before the narrative hardens, make sure you resubscribe. This channel exists for moments like this when understanding the structure early matters more than reacting late. The mistake most people make is assuming financial stress announces itself loudly. It doesn't. It builds in places that don't get airtime, in markets that are considered boring, functional, taken for granted. These are the markets that provide inputs, collateral, and assumptions for the rest of the system. When they strain, the effects don't stay contained. Right now, that strain is coming from a market most investors only think about in passing. A market that sits at the intersection of industry, infrastructure, and finance. One that feeds construction, electrification, manufacturing, and defense. One that underpins growth narratives without ever being the headline. When pricing in that market stops reflecting availability, the system feels it everywhere else. The early signals aren't crashes. They're spread, delivery delays, inventory behavior that doesn't match paper prices. They're small mismatches that get dismissed as temporary. But mismatches don't stay small when leverage and derivatives are involved. TIE. Compound banks understand this dynamic well. They don't wait for headlines. They watch flow, exposure, and sensitivity. When a quiet market begins to move in a way that threatens balance sheets, adjustments happen quietly. Hedging increases. Lending standards tighten. Risk committees get cautious. None of this shows up on a chart meant for retail eyes, but it changes how capital moves. This is where the broader financial system becomes vulnerable, not because one asset fails, but because assumptions stack on top of each other. Growth assumes stable inputs. Debt assumes predictable costs. Derivatives assume liquidity. When one of those assumptions weakens, the system compensates often by pulling stress into places people are watching, like silver. That's why focusing only on the visible market misses the point. Silver reacts. It doesn't originate the pressure. By the time it moves decisively, something else has already shifted. The real question isn't what silver will do next. It's what's forcing the system to reprice risk in the first place. We're still early enough that this imbalance sounds abstract, technical, easy to ignore. That won't last. When quiet markets start dictating loud outcomes, the transition feels sudden, even though it was building the entire time. The reason this kind of pressure is so easy to miss is because it doesn't look like a crisis at first. There's no sudden collapse, no dramatic headline, no single number flashing red across every screen. Instead, it shows up as friction, small inefficiencies that start appearing where efficiency is assumed. And in a system built on leverage and just-in-time assumptions, friction is the earliest warning sign. This quiet market plays a unique role because it isn't optional. It's not speculative. It's embedded. It feeds into physical production, infrastructure, timelines, and long-term contracts that can't be renegotiated. When availability tightens or pricing behavior shifts, companies can't simply walk away. They have to absorb the pressure somewhere else. That absorption often shows up as higher costs, delayed projects, or thinner margins, long before it shows up as price spikes. On paper, everything can still look fine. Futures markets can remain liquid. Prices can appear orderly, but underneath, inventories begin behaving differently. Material moves less freely. Holders become less willing to part with supply at posted prices. Delivery timelines stretch. These are not dramatic signals, but they are consistent ones. And consistency is what matters. Financial institutions pay close attention to this phase because it directly affects risk models. Many balance sheets assume stable input costs and reliable settlement. When a market starts behaving in a way that challenges those assumptions, sensitivity increases across the system. Small price moves suddenly matter more. Correlations that once felt theoretical start showing up in real exposures. This is where stress migrates, not because anyone panics, but because risk has to go somewhere. If it can't be absorbed quietly in the originating market, it gets pushed outward. Lending standards adjust. Collateral haircuts widen. Counterparties become more selective. None of this requires a formal decision. It's the system reacting automatically. What makes this especially important is timing. These adjustments tend to happen before the broader market is aware of the cause. By the time investors notice increased volatility in more visible assets, the originating pressure has already done its work. The reaction feels sudden only because the buildup was ignored. This is also why focusing on individual price targets misses the larger picture. The issue isn't how high or low a specific asset trades. It's how stress propagates. Quiet markets don't stay quiet when they sit upstream from everything else. They transmit imbalance, whether people are watching or not. Historically, this is how larger financial shifts begin, not with spectacle, but with subtle changes in behavior among participants who can't afford to be wrong. When those participants adjust, liquidity patterns change. And when liquidity changes, price discovery follows. Most people won't recognize this phase for what it is. They'll see isolated stories, unrelated events, and temporary explanations. But systems don't break in isolation. They break when small stresses align and reinforce each other. The key takeaway here is simple, but uncomfortable. By the time the problem becomes obvious, it's no longer confined to the quiet market where it began. It's already reshaping the financial landscape around it. What turns this kind of imbalance from manageable to systemic is the way modern finance amplifies small problems. Markets today don't operate independently. They're layered, interconnected, and optimized for efficiency, not resilience. When a quiet market begins to behave unpredictably, it doesn't just affect producers and consumers. It affects the assumptions sitting inside models, contracts, and derivatives tied to that market. A large portion of financial exposure is built on the idea that certain inputs will remain available, liquid, and fairly priced. Those assumptions allow leverage to exist comfortably. They allow institutions to hedge narrowly instead of broadly. When reality starts drifting away from those assumptions, leverage becomes fragile. A move that would have been insignificant under normal conditions suddenly matters. This is where derivatives quietly become a transmission mechanism. Futures, options, and swaps don't create stress on their own. They magnify it. When price behavior stops matching expected patterns, margin requirements adjust. Volatility thresholds get triggered. Positions that were safe yesterday require more capital today. That forces participants to either post collateral or reduce exposure. Neither option is neutral. As exposure is reduced, liquidity thins. Thinner liquidity increases price sensitivity. Increased sensitivity creates more volatility. This feedback loop doesn't require panic to function. It's mechanical. It's automated. And once it starts, it tends to spread outward to related markets. Even if fundamentals there haven't changed. Banks are particularly sensitive to this stage because they sit in the middle of these relationships. They don't just face price risk, they face counterparty risk. When uncertainty increases in one part of the system, banks respond by protecting themselves everywhere. Credit conditions tighten. Terms change. Balance sheets become more conservative. These decisions aren't headlines, but they affect everything downstream. This is how a quiet market begins to influence louder ones. Not through speculation, but through constraints. Projects get delayed. Financing costs rise. Risk appetite shrinks. Assets that rely on abundant liquidity feel the change first. Those that depend on confidence feel it next. What makes this phase deceptive is that prices can still move higher, even as stress builds. Rising prices don't always signal strength. Sometimes they signal strain. When availability tightens and hedging becomes difficult, prices can gap upward while liquidity deteriorates underneath. That combination is unstable, not bullish. Most observers misinterpret this moment. They see price action and assume direction. They don't see the plumbing. They don't see how settlement risk Delivery, timing, and collateral requirements are interacting. By the time those factors surface in public narratives, the adjustment is already well underway. This is why focusing on one asset misses the point. The issue isn't which market moves first, it's how pressure migrates through the system once assumptions stop holding. Quiet markets are dangerous, precisely because they're embedded in everything else. When this stage unfolds, outcomes diverge quickly. Those who understand structure recognize the signs and slow down. Those who don't interpret volatility as opportunity or failure, depending on emotion. The system doesn't reward either reaction consistently. It rewards awareness. We're now in the phase where the mechanics matter more than the headlines. And once mechanics take over, the timeline compresses. As this pressure builds, history becomes the most useful guide. Not because it predicts exact outcomes, but because it reveals how systems behave when assumptions fail. Quiet markets have played this role before. They don't grab attention until they've already reshaped the landscape. In past cycles, stress rarely started where investors were looking. It began in inputs, funding markets, or settlement mechanisms that were assumed to be stable. When those areas tightened, the effects rippled outward. What followed wasn't an immediate collapse, but a period of confusion where signals conflicted and confidence eroded unevenly. One of the most common mistakes during this phase is assuming authorities will step in quickly and cleanly. Intervention can slow the process, but it doesn't remove the underlying imbalance. In fact, it often redistributes it. Supporting one area of the system tends to increase pressure somewhere else. Liquidity injections stabilize prices, but they also distort incentives. Over time, those distortions accumulate. This is why quiet markets matter so much in the historical record. They're often where policy tools have the least direct influence. You can adjust interest rates, expand balance sheets, or issue guidance. But you can't easily manufacture physical availability or rewrite long-term supply constraints. When stress originates there, it resists quick fixes. As adjustments ripple outward, narratives lag reality. Market participants look for simple explanations, but systems don't move for simple reasons. Multiple pressures align, reinforce each other, and then release. By the time a clear story emerges, positioning has already changed. Another historical pattern is the way volatility clusters late in the process. Early stages feel manageable, then reactions become sharper. Corrections overshoot. Rebounds are violent. This isn't chaos. It's the system recalibrating under strain, assets tied closely to liquidity. Feel it first. Assets tied to confidence follow. The uncomfortable truth is that most people aren't prepared for this environment because it doesn't behave the way they expect markets to behave. They look for confirmation and instead get contradiction. They look for trends and instead get reversals. Without a framework, it feels random. With one, it feels familiar. Quiet markets don't stay quiet when they're embedded in everything else. They act as fault lines. Pressure accumulates invisibly until a shift forces recognition. When that happens, the transition feels sudden, even though it was gradual. This stage is less about forecasting and more about awareness. Understanding that the system is adjusting, not breaking, changes how decisions are made. Those who mistake adjustment for failure tend to react emotionally. Those who recognize the pattern tend to slow down and observe. We're approaching the part of the cycle where these distinctions matter most, not because of any single headline, but because of how many assumptions are being tested at once. What defines the final phase of moments like this isn't a dramatic breaking point. It's a shift in behavior. The system doesn't fail all at once. It tightens. Choices narrow. Optionality disappears, and participants who were comfortable operating on assumptions suddenly have to operate on constraints. BT stage, the quiet market that started the process, no longer needs to move aggressively to exert influence. Its impact is already embedded. Financing decisions have changed. Risk tolerance has adjusted. Liquidity has become selective. The system is behaving differently, even if prices in visible markets are still fluctuating. This is where many observers misjudge what's happening. They look for a single confirmation event, a headline that proves everything they suspect. But systems rarely offer that clarity. Instead, they reveal themselves through persistence. Stress doesn't go away. It migrates. It shows up in delays, in tighter conditions, in sudden volatility where stability was assumed. At this point, the most important distinction is between noise and signal. Sharp moves don't automatically mean resolution. Calm periods don't they mean safety? What matters is whether the underlying imbalance that started the process has been addressed. In most cases, it hasn't. It's been redistributed. This is also where silver re-enters the conversation, not as a headline asset, but as a responder. It reflects what's already happened elsewhere. When confidence in inputs, funding, or settlement weakens, assets tied to trust and tangibility adjust. Not instantly, but decisively over time. Silver doesn't cause the stress. It absorbs it. For those watching closely, this phase isn't about prediction. It's about interpretation. Understanding that the system is adapting under pressure changes expectations. Volatility stops feeling random. Contradictory signals stop feeling confusing. They become part of a recognizable pattern. The risk for most participants isn't being wrong about direction. It's reacting emotionally to transitions they didn't anticipate. When markets stop behaving smoothly, impatience becomes costly. Overconfidence becomes dangerous. The environment rewards those who remain flexible and attentive. If you've followed this entire breakdown, you're already ahead of where most narratives will eventually land. You're thinking in terms of structure instead of headlines, process instead of price. That perspective doesn't eliminate uncertainty, but it makes it navigable. I'm interested in what you're seeing as these shifts unfold. Are you noticing tighter conditions, changing behavior, or unexpected volatility where stability used to be assumed? Share your perspective in the comments. Conversations like this matter when the signals are subtle. And if this helped you understand what's really driving the system beneath the surface, consider sharing it with someone who's still focused on the obvious. The quiet forces shaping outcomes are rarely the ones getting the most attention.